Hello, and welcome to Market Insights. While debt fears of different flavors have cycled in and out of popularity for years, in this episode we'll focus on corporate debt. A common fear we've heard since 2016 is that the low interest rate environment encouraged corporations to take on too much debt. And once rates begin to rise, over-indebted companies will have to slash investment, ramping up the risk of recession. Some pundits warn debt-laden companies are now turning to leveraged loans for financing, making the situation even riskier. However, if you take a broader look at corporate finances, things look a lot less scary. Whenever you're dealing with a large number, scaling it is always a good place to start. Total non-financial corporate debt reached over $20 trillion this summer. That's big, but context is key. Debt is only one side of a company's balance sheet. The other side is assets, which are quite important. Non-financial corporate assets are a record high $44 trillion, more than double outstanding debt. This figure includes nearly $2.7 trillion in cash and cash equivalents. So when scaled properly, that mountain of corporate debt doesn't seem as daunting. Another important factor is a borrower's ability to pay its debts. A good way to measure this is to divide a company's ongoing interest expense by its earnings before interest and taxes. This calculation is known as the interest coverage ratio. The higher the ratio, the easier a company can pay off its debt. Currently, large US corporations have an interest coverage ratio of roughly 7, meaning they can pay their ongoing interest payments nearly 7 times over without becoming unprofitable. While recent quarters have shown falling interest coverage, it is still near generational highs. Some fear rising interest rates may hinder companies' abilities to pay off future debt, but the majority of corporate debt is issued at a fixed rate, so it is unaffected by market rate fluctuations. That leaves under 5% of outstanding non-financial corporate bonds vulnerable to rising interest rates in the near term. Presently, in light of moderate global inflation, lending, and money supply growth, we expect long-term interest rates to move largely sideways. Plus, credit spreads usually narrow as bull markets mature, which further favors benign corporate bond yields. Yet even if interest rates do rise, over 75% of outstanding non-financial corporate bonds do not mature until after 2020, and roughly 43% mature after 2025. That's 7 years away, a long time from now, and further out than markets usually look. Interest rates over that entire span are unknowable today. None of this is to say companies can't get in over their heads in debt at some time in the future. We may also see some individual companies fold if they aren't able to refinance debt, as was the case with Toys R Us a few months ago. But as far as total corporate debt being a broad economic risk, corporate America's balance sheet is quite healthy, overall and on average, suggesting this isn't a ticking time bomb.